Ladies and gentlemen, welcome back to another episode of our Thrive in China roundtable. I am broadcasting actually currently from London, so a little bit of a different background, as you can see, different environment. Apologies for any external noises that come in. Today's topic is about tax preferential policies that exist in China. What are they? Could they apply to you? But most importantly in this topic, we're also going to be talking about tax planning and how sometimes these tax preferential policies can be useless, but many people aren't aware of that. So we're going to go cracking on. Before we start today's presentation, however, what I always like to do is find out who is in my audience, who is in our Thrive in China community. As you know, my colleague Joe is starting to email you to understand a little bit more about you. I hope that you are responding to him. It always gives us great insight into our audience, your needs, and how we can tailor make our presentations for next year. And most importantly, what topics do you need to be educated on? So if you are a newbie in China, a startup in China, an experienced China hand, do let us know. Like I said, it gives us tremendous insight. A little bit about myself, for those of you who don't know me, my name is Christina Kohler-Colucci. I'm the head of business advisory at Woodburn Accountants and Advisors. I am one of the leading experts on inbound investment to China. What that means is that we work solely with foreign investors that are looking to enter into the China, Hong Kong, and APAC markets. I personally have over 20 years of experience in corporate services, corporate administration. We've helped over 750 companies with their market entry strategies, their implementations of their business models, as well as looking at their growth and their scaling opportunities, not only in China, but also within the APAC region. If you are new to our Thrive in China community and you haven't received our ebook yet, we are offering a free complimentary copy of our ebook on the 10 biggest mistakes companies make in China. Email me at christina@woodburnglobal.com if you haven't received your copy yet. So let's get cracking on today's topic. We are actually on roundtable 33 for the calendar year of 2023. The topic we're talking about are what the preferential tax policies in China are. Just to highlight to everybody, if you are interested in viewing our former roundtables, they are all recorded and they are all up on a specific playlist on our YouTube channel. A link will be provided in our email that we send out later. Do take a look at those. And in your spare time, if you need that information, it is all there on that playlist. So I want to start today. And actually, when I was creating this presentation, it was actually going to be a very short presentation because I can highlight to you what the tax policies are. I can give you examples of how they would be implemented within your businesses in China. But I really wanted to focus today on tax planning because most people, when they think about China and they think about entering the Chinese market, they take a look at all of the incentives being offered without actually calculating and planning when those incentives would actually be applicable to them, okay? When it comes to tax planning, there's 1% of my clients who are profitable from day one. The majority of my clients are only profitable from about year 3 to year 5, if not later. So when companies say to me, Christina, I want to locate in this location, or I want to visit this application because I want to achieve these incentives, their mindset is on really the short term and thinking now and not thinking in the long term how the business is going to evolve and whether you are actually going to be profitable or not to take advantage of these incentives. So let's start off today's presentation with who is considered a tax resident in China, because sometimes there are also misconceptions on what that definition is. Now, the definition of a tax resident in China is a company that has been established in China, and also, most importantly, that the effective management, i.e. the responsible decision-making people are residing in China as well. Effective management, again, means that the substantial and overall management of the business is in China. First and foremost, if you have registered an entity in China, regardless of that effective management component, you are considered a tax resident, okay? If you don't have an entity in China, but actually all of the effective management is sitting in China through another structure, another entity, that business should actually be considered as a tax resident. And this is where permanent establishment guidelines come into play. Permanent establishment guidelines are actually indicated and listed within the double taxation agreements between jurisdictions. So I'm currently in the UK, I'm in London, so I'll use the UK as an example. If you look at the double taxation agreement between the UK and China, there will be guidelines and clauses in relation to effective management, which can trigger permanent establishment guidelines, where then you become a tax resident in China, okay? If you do have any questions whatsoever on tax residency, please insert that into the chat box, and we will get to those questions during the Q&A. Now, what you've all come here for. You've all come here to understand what tax policies are being provided. This is the list. This is the main list that I do want to touch on today, okay? There might be certain ones that I myself am not even aware of because they are in small villages, towns, districts that, you know, I'm not aware of on a day-to-day basis. It would really be if you've been so again, I've been working with the China-Britain Business Council. They've got a delegation coming in, I believe, from Wuhan, where they're going to highlight the advantages of establishing in Wuhan and certain districts that might offer grants, subsidies, as well as tax incentives. These become really tailor-made and could also be promotional incentives that are only applicable to members of the China-Britain Business Council. So it's really important to understand the localities of where you're looking to establish to see whether there are specific incentives in those locations. But generally, throughout China, these are the standard incentives that are being offered in terms of tax incentives, okay? And on this presentation, I am going to be focusing on the incentives in relation to profits tax, all right? So as you may or may not be aware of, the standard profit income tax rate in China is 25%. There are numerous terminologies for profit tax. So on this slide, I've used corporate income tax. Another terminology will be enterprise income tax, or very simply just profits tax. So this is unified at 25%. Now, if you are considered a small scale enterprise, meaning you are a small SME, the definition of that is that your income, your net income is less than $1 million or less than 3 million, then you will have special income tax rates associated. So if your net income in a fiscal year is less than 1 million RMB, your profits tax rate is 3%. If it's between 1 and 3 million RMB, it is at 10%. Now, this is just to highlight, as I have mentioned here, that this special preferential treatment thus far is only valid until the end of this year. So far, we have not heard of extensions. My feeling is that as China has only just opened up to the world and opened its borders, that this will be extended on at least for another year, if not 2 years, but it is still to be seen. There have been no circulars or guidelines on this as of yet. Then you've got the high technology enterprises, which is HNTE, or the technology advanced service enterprises. Now, the key thing to understand with this is that you first have to establish an entity in China. You cannot apply for these preferential treatments until you have that entity in place. So you need to register your company. Once your company is registered, you have to understand from your district tax bureau what are the guidelines and criteria that are specific. Now, I have not added the slide here in relation to what the criteria are because it is so generic And we have seen regional variances that I'm hoping to encourage and emphasize you that if you want to apply for these items, you go to your tax officer, you discuss it, and you get their criteria, okay? In general, the criteria for the high-tech enterprises is that you have to have a certain number of employees, a certain size office, you have to have a lot of your trademarks, patents, and R&D collateral registered under the Chinese entity, not by your overseas entity, which most companies don't want to do. There also has to be a certain portion of R&D employees employed by the company. So there's a ratio of about 30 to 70, meaning that 30% of your employees should have special qualifications, educational qualifications, and 70% don't. But if you are successful with these applications, then the profits tax rate would be at 15%. Now, I want to highlight here, and again, re-emphasize, you have to have this understanding that the tax bureaus in China want you to pay tax. And in an ideal world, they want you to pay tax at the 25% profits tax rate. Like this, they earn more tax dollars. They are also then hitting the KPIs that have been set by their regional tax bureaus, by the State Administration of Taxation. So every tax bureau has a KPI in terms of what they should be achieving. And obviously, the higher the tax rate, the more tax dollars they earn, the more they're going to reach their KPIs. So the application to obtain the 15% for high-tech enterprises or technology advanced service enterprises is going to be difficult, which is why there are these regional variances where some tax bureaus are not as rigid and strict as others, okay? And please don't look at then, oh, I will set up in this area because the tax bureau is less rigid than here. That's a silly, in my perspective, that's a very silly thought process. You need to set up where it is logical for you to set up to be able to grow and scale your business. So when you go through these applications, you need to understand that you have to fulfill the criteria, you will have to provide supporting documentation, and it is not always a guarantee that you will be successful in obtaining these rates, okay? So one of the key things that I highlight to a lot of my clients is when you are preparing your budgets for entry into the Chinese market, I would prefer that my clients make their budget by not looking at these preferential tax rates, but rather by looking at the unified 25%. If you get the 15% rate, that is fantastic news. You can then rebudget, reforecast based on those better rates. But it's better to be conservative and prepare for the worst than prepare for the best. The next category that I want to highlight here is companies engaged in encouraged industries in certain regions, okay? Unfortunately, one of the names that I had actually written on here has not stayed. It did not save. But I've put in here the Shanghai, Shenzhen, Hong Kong Modern Services Industry Cooperation Zone. You've got all the areas in Western China in terms of Chengdu, Chongqing. You've got Zhuhai. You've also got Hainan Island. In Shanghai now, you also have Lingang. Now, again, if you establish your business in these zones, in these areas, in these promotional regions, you will get a 15% tax rate. However, one of the biggest news of 2023 was that Shanghai, I believe, by 31st of December 2025, will revoke this policy of the 15% preferential treatment. And from January 1st, 2026, you have to pay at the unified rate of 25%. So it does not mean that if you establish in these jurisdictions, in these promotional regions, that these 15% rate is forever. It is clear that it is not forever, that it is for a limited period of time, and nobody can tell you what that limited period of time is. So if you establish today in Shanghai, I can tell you now that this rate will not apply by 2026. And if you're not profitable in 24, 25, what's the point of setting up there? Don't choose a location just because of the preferential rate. You want to choose a location because of the strategic place that it is in for, again, the growth and the scaling of your business. So don't always rely. I have way too many clients who choose locations by these incentives. I'm trying to encourage you to look at other benefits and other strategic analysis points to choose a location. The next one, very similar to the high-tech technology advanced service enterprises, is the key software production enterprises and IC design enterprises. Here, the rate is at 10%, but again, you have to go through an application procedure, and it is never a guarantee that you're going to achieve this. So here I've provided to you insight into the corporate income tax world and the incentives that do exist, okay? There are other sectors and industries like clean tech where you will also gain benefits if you can prove that you truly are in the clean tech world. And then there are also preferential tax rates of about between 10 and 15%. So it also really depends on your industries and your sectors. But what I want to finish off with today's presentation is tax planning, okay? The whole spiel of this presentation today is, are there preferential tax policies? But it's also then looking at how can we implement that in our business and are they applicable to us? The only way to find out whether these incentives are applicable to you is to do a tax planning exercise, right? So one of the biggest questions I raise to my clients is, when will your company in China be profitable? Have you done an analysis of when you are expecting to become profitable? Yesterday, I met with an existing client of mine who's been in China now for 3 years, and they're still running at a loss. They're 3 years in. Okay, hopefully and obviously a big component of that is due to COVID, but they have not properly launched their business because of COVID, and their big push now is in 2024, okay? Their forecast from 3 years ago was that by now they'd be profitable in China and they would be implementing their profit repatriation strategies. That's not the case. So you also have to look year on year and reforecast and reanalyze based on your projections and how you're planning to grow and scale, or whether you have to maintain status quo because of the economic climate. So when you are looking at tax planning, right, I have taken just an example of a company that would have established itself this year, okay? So we're in year one. 2023 is year one. The business license of the company has been issued in March of 2023. It's been decided that the registered capital or the working capital of this company is going to be about 100,000 USD. I did not update that exchange rate, so that might not be accurate, but it's just to say it would be about 1 million, a little bit less than 1 million renminbi in capital, okay? Now, when you start up in China, that money is to be used to pay for all of your local expenses, okay? So the first question that I raised to my clients is, as we were setting up the structure, your head office paid for a lot of the costs to build up the business. They paid for the deposit on the rent of the office. They might have paid the first 3 or 4 months of rent. You might have started hiring people, but then the salaries were paid from the head office. Do you want those upfront costs to be repaid using that registered capital? There is no law in China stating that you have to do this, but I do have certain clients that are large in size where this repayment has to happen, okay? Now, these repayments need to be done within the first year of operation. So really, you have from March 2023 to February 2024 to get all of these upfront costs repaid. If that means you are going to repay the full working capital amount of 100,000 USD, this for me is pointless. You need to use this money for working capital for the actual operation of the business, not to repay the HQ. You have to find then other ways to repay the HQ. And this is part of the strategic thinking when you're setting up the company. This is also a question I raise at that moment in time because it could impact the value that you decide the working capital to be. All right. So this is year one. These are the key fundamental aspects. And obviously you're growing the business and you're creating a solid foundation of the business. Like I said earlier, I have only about 1% of my clients who are actually profitable by year one. But that is because these are companies who are literally moving their transactions from one entity to their Chinese entity. That means they've already been proactive in changing contracts with clients so that they can build up sales revenue within their Chinese entity almost immediately. Okay. For 99% of my clients, this is not the case. First of all, they're not as proactive. They're not as organized in getting all of these contracts redone. Sometimes they have to renegotiate the terms and conditions with their clients, in which case it's taking much longer and they have to reforecast because they're not earning any sales revenue. Okay. Now I am taking this tax planning based on my 99% of my clients, not that very unique 1%. Okay. So if we look now at year 2, we're looking at January 2024 to December 2024. Generally at this stage, you know, March to December 2023 was really building up the foundation of the administration side of the business, understanding where we are in terms of changing contracts or initiating new contracts and earning revenue. By January 2024, you want to start thinking about repatriation strategies. And I say this because it takes a long time to register those contracts with the tax bureaus. And you also want to tie it in with transfer pricing arrangements and whether you need to do any benchmarking analyses, local benchmarking analyses or not. Again, this all depends on the size of your company, the resources that you have, and whether you want to initiate this. But from an outsourced accounting perspective, these are the questions I start raising with my clients in year 2. Okay. Now, working capital has been used, right? The 100,000 US dollars has been used from March 2023 to March 2024 to grow headcount, pay for local expenses, pay for the office rent, pay for professional service fees, pay your suppliers, whatever the case might be. And you might find that the 100,000 US dollars is not enough and you're running out of it. There's always going to be a trigger that your accountant needs to be aware of to highlight to HQ, guys, we're running out of money. We're not earning enough in revenue. How are we going to get more money into the business? Okay. You're going to get more money into the business if you start invoicing locally to your customers or you start invoicing overseas to your customers, depending on what your business model is. Okay. But you need to figure out how you can sustain the operations that you do not run out of cash. Please be reminded that cash is king in China. Without having local financial resources available to you, you will run into difficulties. I have had clients who have not been able to get money into the country for whatever decision-making reasons, and it meant that sometimes they had employees who didn't receive salaries for 2-3 months. Okay, so please make sure that you are tracking your bank balances, you're tracking how the money is being utilized, and how you are starting your transactional business. If your business model is purely that you are a cost center, then obviously as a cost center, you only have expenses, okay? And you're not generating revenue. But if your business model is a cost center, then those preferential tax policies mean nothing to you because you'll always be at a loss. They will never be implemented, okay? So if your business model is cost center, this presentation doesn't mean anything. Those tax policies won't be implemented at all. If the idea is that your business in China is actually going to be transactional, you plan on making revenue, you plan on making this an independent structure, then of course you will have profit, whether it's a loss or whether it's a gain, right? So this is year 2. A lot of things to think about from a financial and administrative perspective. A question that needs to be raised consistently throughout year 2, questions that need to be raised consistently is, does registered capital have to be increased? Do you need to get your foreign debt loan into the country? Do you need to create service agreements in order to be able to obtain funds quickly? How easily is it to get those service agreements approved by the tax bureau? What are the implications from the banks in terms of receiving funds based off of those service agreements? There are so many questions that need to be asked with your finance team and decisions to be made in terms of how you're going to actually operate your business. But I want to highlight, by the end of year 2, you're still not profitable, which means that all of those tax rates mean nothing. okay? Now we're starting year 3. We're looking at January 2025. Hopefully by then, you would be 2 years in operation. You might find that the revenue is still not enough to sustain the company because inflation rates, slow economy, maybe you need to spend more money on brand awareness and marketing. There could be so many different scenarios happening that mean that your revenue is still not large enough to sustain the business, okay? Could also mean that you're doing fabulously, but you need to reinvest the money you're making into the business to hire more headcount, to build momentum, and to be consistent, right, with the growth of the business. But remember, you're still not really profitable. You might have months where you're making money, but then you might have other months where you're making a loss, okay? So even in year 3, even in year 2025, you probably won't have any, you won't have to implement any of the preferential policies. Now, again, I want to highlight that year 3 is usually the break-even point for a lot of my clients, could also be year 4, all right? So if we now look at year 4, which is January 2026, we are looking at the company is almost break even, okay? Revenue is there to cover all of the expenses, and actually you're not asking headquarter anymore for money. You are able to sustain the operation with what you are earning, okay? Obviously, like I said, there might be fluctuations. You might have 1 month where you earn more, 1 month where you earn less. That is just how business is done, right? It's really hard to keep consistency when you are in the startup phase. Okay. Now, a question that gets raised a lot is that, you know, I'll have clients who say, oh my God, in Q1, we made so much money. I want to repatriate that so that I pay less profits tax in China. But then they forget to think, do we actually need that money for further investment for the rest of the year? What happens if in Q2, the results are not as successful? Okay. So again, this is a balancing act where we need to look at the ambitions, the goals, the objectives of the head office. Where do they want that money to sit? What is their risk level? What are the opportunity levels? And analyzing that month to month to say, okay, when do we start repatriating funds? This is why those repatriation strategies and those agreements that I highlighted for year 2 need to start being implemented and having been registered, so that when you raise an invoice, it is a matter of just getting the process through versus waiting for the applications of the service agreements to be approved by the tax bureau and the bank. Okay, so this is really, really, really important to think about. Are you going to send money back, or are you going to keep it within the country? All right. And obviously, it is around this time, because profits tax is declared on a quarterly basis, where you might find that in January, the period January to March, you're going to pay profits tax. In which case, which rate are you paying? Like I said, for anybody that has a net income of under 1 million RMB, the tax rate is 3%. Okay, regardless of whether you've applied for high tech or not. In fact, we have a client, actually, this was a discussion point last week with a client of ours. We have a client who has applied for the high tech enterprise status of 15%, but they are generating a net income of less than 1 million. But because they've applied for that status, they're going to have to pay 15% versus the 3%. So why is everybody in a rush to apply for these critical components without thinking at what level are we at in terms of our income? Okay, so they can't take advantage of the 3%. They are automatically on the 15% rate, and it is indicated within their tax bureau system. And because they've done the application and it's taken months to do that application, they can't go backwards now. Okay, but they were so keen on getting it. So it's again a true balancing act where you really need to talk to your accountants and analyze what is the best strategy to take in all of this. Okay. So remember that you can have a quarter where you're paying profits tax, but you can have 2 quarters where you're not paying any profits tax. Then you can have Q4 again where you pay profits tax, and then you have to look at your annual profits tax filing and what are the total amounts that are applicable. All right, but there is this balancing act that has to happen. Year 5, and generally that's the goal that I want everybody to try and achieve if it's feasible, is that by year 5 you are profitable. And I'll tell you why I wish this for my clients. I wish this for my clients because most tax officers will come to you in year 5. And if you're still not profitable, they will say, why are you still in China if you're not profitable? What's the point of being here? Right? They will raise questions about your business model. Are you repatriating fund? Are you repatriating too much funds overseas? At some point, you do need to declare income. Tax needs to be paid somewhere, guys, right? We don't want to evade taxes. We want to optimize our tax situations. So be prepared that in year 5, if you're still not profitable, the tax officers will raise questions and you have to be able to answer them, okay? So in an ideal world, by year 5, you are profitable, your revenue is stable. The question is, what level is your net income? Are you able to benefit from the small, medium-sized rates, which are 3 and 10%, or are you applying for high-tech rates, or are you located in a district where automatically that rate is at 15%? Okay, so we got to understand all of this, right? Now, I want you all to understand that we're now in year 5. This is 5 years into the future. Okay, I cannot tell you 5 years into the future what the Chinese the State Administration of Taxation, or generally the Chinese government, will say about taxation. I don't know if the 25%, which is the standard corporate income tax rate, will be increased, will be lowered. I don't know if certain regions will start revoking their preferential tax policies, like Qianhai has done in Shenzhen. I don't know. Nobody can predict what will happen in 5 years' time. And because there are constant changes in the in the tax rates and tax decisions, it is hard to predict and forecast. So you've really got to look year 1 individually, year 2 individually, year 3 individually, and pivot and make changes, right, to take advantage of whatever new laws are popping up or new regulations are popping up. All right. So it's really hard to make this planning. And I guess for me, the purpose of talking about the preferential tax policies is really because a lot of my clients make location decisions based on these preferential tax policies. Or their internal team make decisions without really talking to tax advisors or accountants about the pros and cons of making these types of applications and when these applications should actually be done, at what stage of your growth and your startup phase, okay? So I really want people to understand all of that. To finish off today's presentation, I want to give you a couple of tips and action points if you haven't done this already within your organizations. The first is your team needs to meet with your tax officer and visit the tax bureau. Develop a relationship, develop an open dialogue, communication about what the company is doing, what are the future plans, what tax rates would be imposed, and getting already an understanding of the dynamic. We have found that most of our clients do not like to divulge too much information to the tax officers. I don't know if it's a privacy issue, if they're worried suddenly something will happen to them. If you don't have this open dialogue, you will not have that transparency to be able to plan. The third one is looking at your repatriation strategies early enough in the game so that you can get your contracts approved, but also have the plan in place for when you want to start issuing that invoice and repatriating money abroad. I will never forget, this was really about 10, 15 years ago. I had a client who was in the chemical industry, and they won a state-owned project where they were going to make millions within a very short period of time. And I remember it being in the second half of the year. And they said, oh, you know, Christina, I mean, we don't want to pay the 25, I think in those days it was 15%, the 15% profits tax rate. We want to be able to repatriate the funds sooner so that we have a lower tax liability, tax implication. There was absolutely no time left in the year to get these repatriation strategies set up, contracts written, contracts approved, to then repatriate the funds before December 31st, which meant that most of that income that they earned was taxable, and they had a really high tax liability for that year, which was a pity because they just were not prepared. The other point to look at, and again, we didn't talk about VAT here today because we can, there are preferential tax policies in relation to VAT, but it really depends on what your status is. Whether for general VAT taxpayers, there is no preferential treatment. It's really only for small scale taxpayers, where the rates are lower, and where you also get VAT exemption if you have a low revenue level. So if you do 300,000 RMB of revenue in a quarter period, you're VAT exempt. So there are policies available to you. Again, it's open dialogue with your tax officer to understand what those policies are, but also make sure that now with the whole e-Fapiao system, that you have proper compliance procedures in place as part of your daily operations in terms of who is filing that, who's keeping all the vouchers, etc. We are in the accounting profession. There is human error. We want to limit that human error as much as possible. So it's really important to have standard operating procedures and guidelines in place to keep things accurate, correct, to limit that human error potential. Then last but not least, it's communication with your Chinese accountant, which does not happen enough, right? Your business strategy is tied with your finance strategy, and you need to be able to communicate with your Chinese accountant on that, okay? Your Chinese accountants should act as your financial controllers, your financial advisors. They should be giving you ideas, brainstorming with you on how to optimize your tax situation in China, whether it is to take advantage of the preferential policies or not, okay? Now, again, there is great debate among startups in China about whether there is a true value in having a proper Chinese accountant, whether outsourced or in-house. If you are interested, on our playlist, we have a video on how to work with your Chinese accountant, which gives you tips, guidelines, as well as descriptive job functions that they should be doing. Take a look at that so you truly understand what is the value that these Chinese accounts should be bringing to your business, okay? And accept that value, because it's really important to have these people on board guiding you in your operations and making sure you can take advantage of the situations that exist. Remember, they have tremendous knowledge level and sometimes even networks with tax officers, tax bureaus, in order to be able to obtain these preferential treatments. So that is the end of today's presentation, guys. As usual, I would love to hear what your biggest takeaway from today was. It always gives me insight on how to improve the presentations. If you also have any questions, now is the time to list those questions in the chat box, and we will touch them at the end of the recording. So type away, and we will get to them. Just to finish off in terms of a bit of bureaucracy, if you are not comfortable raising these questions in a public forum and you would prefer to have a more one-to-one chat, I will be providing you with a link to my diary, where I send you the recording of today's presentation. There will be a link. You can click on it, goes directly to my calendar, and we can set up a free 30-minute discovery call to see if we can basically discuss your pain points and see if we can be of any assistance to you. As part of the services that we offer at Woodburn Accountants and Advisors is that we can act as your full outsourced accounting provider, meaning that we do all of these types of applications and give you this type of insight and advisory in terms of how to improve your operations. If you want to bring the conversation also into our community, so we have a community on WeChat of about over 300 professionals. It's all business people who are looking for advice one to the other. It might not be that you need something straight away, but it's a great avenue to see that you're not the only one struggling in China. Everybody has issues. A lot of them are extremely similar, and it's about sharing that in the community. This is my QR code. Please connect with me, and I'd be happy to add you into the WeChat community. So again, that you can gain insight and network, build your ecosystem, and have the community advise you as well. We have 2 more sessions of our roundtables for 2023, and we are also in the process of building up our content for 2024. Next week is a bit of a sour subject, but I think it is relevant. We are talking about how difficult it is to liquidate a company in China, or whether it is better to maintain a dormant status. This roundtable is really geared to those of you that are not sure anymore about the Chinese market. The maintenance costs of running an entity maybe are too high, and you're looking for a way possibly to maintain the status of having your entity in China, but just minimizing all the costs, or potentially liquidating. And then last but not least, on the 13th of December, the last topic of the year is how to prepare for corporate administration for 2024. So we're going to be providing you insight in terms of how to do an internal audit within your organization, what needs to be improved in terms of your accounting, finance, HR, corporate governance departments, and how you can streamline that. So stay tuned for those roundtables. And still no questions have popped in. So I do want to say thank you very much for joining us. We do not distribute our PowerPoint presentations, but you can definitely look at the recordings up on our YouTube channel, and we will be providing you that link later on today, if not tomorrow. So thank you once again. Take care and goodbye.